Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the latest agency news, my interview with Garrett McAuley Co's Joe Garrett on the future of mortgage commissions, debating whether automation, shrinking margins, and smarter underwriting tools will make 100 basis point payouts a thing of the past. And in the capital markets, let's have a little reaction to benign CPI and PPI reports from earlier this week. Thanks to Ocrolus for sponsoring today's podcast. Ocrolus is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights. Ocrolus is empowering underwriters to make timely, confident lending decisions. Whether you need to verify income across complex pay scenarios or review borrower documents with confidence, Ocrolus helps mortgage teams move at the speed of automation with the precision of human oversight. Learn more at ocrolus.com/mortgage. Last weekend, Federal Housing Finance Agency sent through official FHFA channels a rumor that Fed Chair Powell was considering resigning. Yesterday, they abandoned official channels and tweeted out a 2-page frequently asked questions document that provides much-needed information on last week's announcement that Fannie Mae and Freddie Mac will begin to accept loans originated using VantageScore 4.0. Our MBA reminded us that there are many open questions that need to be resolved before the GSEs can accept delivery of these loans. Quote, Director Pulte's published FAQ provides the first round of necessary details, highlighting the initiative as a work in progress and that additional details will be provided in the weeks ahead. End quote. As a reminder, in case you were on vacation last week, the GSEs will permit lenders to deliver mortgage loans using a credit score generated by either the classic FICO model or the VantageScore 4.0 model, which is owned by Experian, TransUnion, and Equifax. But for the time being, will not accept scores from multiple models on a single loan. Lenders can choose to report different credit scores on different loans, like VantageScore 4.0 on one loan and FICO Classic on another, just not two scores on a single loan. The GSEs will develop appropriate risk mitigants to ensure safety and soundness. The MBA stated that FICO 10T, owned by Fair Isaac, remains a validated credit score model and is planned for future use, though it is not available for loan deliveries now. The GSEs will announce changes to their selling guides in a future release. An implementation date was not provided. As initially reported, the credit reporting requirement will stay tri-merge. Importantly, however, the FAQs state that FHFA will continue to assess the credit reporting requirements in the future to lower costs for consumers and promote competition and innovation. MBA will use this opportunity to continue exploring a single-file credit report option and other approaches to lowering credit reporting costs. Left to be decided are minor things like loan-level price adjustment grids, minimum credit score eligibility, and business rules around using different scores and different loans, along with the implications for mortgage insurance pricing and investor acceptance of VantageScore 4.0. Turning to the markets, optimism abounded yesterday following the release of a relatively tame-looking June PPI report. Wholesale inflation was flat in June, with the producer price index showing 0 month-over-month growth and a 2.3% year-over-year increase, down from May's 2.7%. Core PPI, which excludes food and energy, was also flat in June, with its annual rate easing to 2.6%. Both the CPI and PPI reports this week showed little evidence of tariff-driven inflation. It would seem there are two competing forces in the housing market right now: increasing inventory levels, helping to make homes more affordable, and declining prices in an increasing number of markets. Homes are taking longer to sell, which is beginning to make homeowners more reluctant to list. The CPI report this week showed shelter costs continued to decline as affordability pressures weigh on the housing market. And finally, I'm not going to spend much breath on this. The Supreme Court telegraphed that President Trump does not have the power to fire Fed Chair Powell, so it's a nothing story for me. A bigger story would be the announcement of a dovish successor well before Powell's term ends in May of next year. For today's interview, I want to welcome back to the show Garrett McAuley Co's Joe Garrett to talk about the future of mortgage commissions, debating whether automation, shrinking margins, and smarter underwriting tools will make 100 basis points payouts a thing of the past. He's principal at Garrett McAuley Co., a banking and mortgage consulting firm that helps lenders increase revenues, control costs, and better manage risk. Additionally, he's the former president and CEO at Sequoia National Bank and American Liberty Bank.
I read in your newsletter this last week, and it's a phenomenal newsletter. I always enjoy opening it.
Thank you.
You have a tremendous open rate, and A lot of the executives around the industry like what you have to say and what Mike has to say. But talking about LO comp, which is such a elephant in the room or touchy issue. I don't know how to put it properly, but it gets people fired up one way or another. It's this kind of what do you call it when something's untouchable? There's a term for um,
Well, the third rail of mortgage banking, maybe.
sure, the third rail of mortgage banking.
Yeah, I actually
Uh,
I don't know if I agree with you that people get worked up about it. I think almost just the opposite. If they got worked up about it, maybe that they would actually try to do something about it. I think using your analogy about the elephant in the room, maybe that's it. They just kind of ignore it. It's too dangerous to mess with. So let's just not talk about it. You
right.
talk to mortgage bankers all the time. Do they talk about it? Do you hear
Well,
them?
I think the prevailing sentiment is something has to change, especially with technology making
Yep.
cream puff loans sail through the pipeline.
Yep.
However, the first company to cut comp is going to see their top originators move to a company
Sure.
that's still willing to pay comp. And so I think that to have a worthwhile discussion today, you and I should get towards what will it take for the industry as a whole to actually be able to lower comp? Is the proper solution or the proper interim solution that based on the difficulty of loan file, comp is going to vary wildly? Is there a way for LOs to make originators to make it back up in other ways if they're losing comp on certain loans? What are your thoughts?
Well, I'm not certain, but if I go back to 1989, um, I bought a very small bank in Los Angeles, moved it up to the Bay Area, and decided that we weren't going to use loan officers. And so we just, we had really good people who answered the phone, and it was pretty unsophisticated, but it worked. It wasn't necessarily scalable, but if people called us, we took what we would have paid in a commission and used it to have lower rates, and so we did get good phone calls coming in, and I think we sort of peaked at maybe 90 million a month. It was a lot for us at the time, maybe a lot for the industry, not very much by today's standards, but we did it. I don't know that we could have grown it that much, but I don't think you can mix and match. I think if you want to have a low cost use of technology or some alternative to loan officers, pretty hard to do that simultaneously while you have a unit and a part of your business that has loan officers that are making 100 basis points a loan. But I think you used a key word, Robbie, when you talked about cream puff loans. Um, I think that there are loan officers probably in every shop, probably every place that might be listening today that has loan officers that do a really good job with difficult loans, difficult properties, difficult borrowers, problems with income, maybe with credit scores, whatever, you name it. And I'm going to hazard to guess that those loan officers earn every penny of their commission for what they do and the magic they perform. But it's the cream puff loans that I'm thinking about, have to somehow be dealt with differently in terms of compensation. And if you just, go back to 2020 or even today, maybe uh, someone's getting a $500,000 loan, maybe a $600,000 loan, and the borrower has a 810 FICO score. The property got a property inspection waiver. Someone's putting 30-40% down, or maybe they're just doing a rate reduction refi. With that 810 FICO score and the LTV, it's hard for me to imagine paying on that $600,000 loan $6,000 for a loan officer. The value that he created was somehow either bringing in that borrower or handling that borrower once the borrower called in. But I would just argue that he doesn't earn that money for the effort involved. So maybe there's a bifurcation for what you call the cream puff loans. And say again, I think it's a great term, versus the more difficult loans. And longer term, um, I don't know. I'll ask you, Robbie. You've got your finger on the pulse of the industry. You know, um, very, very well done in that regard. Do you think there'll be commissions at all in 10, 20 years?
There's varying schools of thought for sure. I think we are moving as an industry toward a process that a lot of loans will be able to sail through the pipeline. And so you could argue that I'm in agreement with you that those loans don't need to be compensated the same way. The flip side of that, which I wholeheartedly believe as well, is that good originators are really good at what they do. Not
Absolutely.
not only from a building their referral pipeline perspective, but from a working deals through the funnel, getting deals done, making borrowers want to come back, and I don't think that can be altered at all. I was thinking when I was listening to your answer, is there a way that originators could be better compensated on certain files than they already are to make up for some of the other loans that will breeze through the process? Because the way I started this conversation was asking about what would it take to actually get to where the industry as a whole pays less comp. And so I'm looking for creative ideas here, I guess, with you on how can the industry not just because one domino falls doesn't mean every domino is going to fall, and that first domino uh, is going to have a tough time attracting top talent. And I'm just trying to figure out how to retain top talent. I think you understand the gist of what I'm
Of
getting.
course I do. There is the compliance issue of, paying different amounts based upon uh, aspects of the loan and the particulars of a given loan, but setting that aside, because, hopefully Congress can deal with that sometime. I think that you need to make a decision as to what you're going to be. So when I talk in LA, we just decided we weren't going to do traditional loan officers, and we never did. And so what we had was young people who they went through a training program, and I don't remember what they did. Maybe they got a little bit of time in processing and underwriting and so on. And they were just sort of a customer service rep, and they were, young people. I think they were happy to get, maybe a year or two out of college, happy to get a salary of maybe 3,000 a month. And those people did a really good job of just shepherding them through. They didn't bring the loan in. We did that through advertising and stuff like that. And I honestly don't remember what we did with difficult loans. I think our general approach was if it was a real difficult loan, we just didn't do it. We had our little model built, and it was for, things that really fit the Fannie Mae box. And if you had to really squeeze to get them in the box, we just wouldn't do them. So people probably forget Countrywide was once the nation's biggest lender. And for many years earlier in their lifespan, they didn't have traditional loan officers. And it really worked. They found out it wasn't scalable, I guess, because then they didn't have branches and they didn't have, commissioned loan officers, but it worked for a while until they wanted to get a lot bigger. So what it takes is somebody, I think, is just willing to make that big bet. And maybe they just start off by having a channel, different name that is not commissioned loan officers, but some kind of a customer service rep to move that loan through the system. But when you think about it, and Robbie, you touched on this, but you've got AI, you've got DU and LP, you've got credit scoring. Fannie Mae has data on millions and millions, probably over 10 million properties now through all the appraisals that they've been getting over the years. And I used to have a service that sent me something every week on property inspection waivers. And between Fannie Mae and Freddie Mac, I think they averaged somewhere, 35% of all the loans going through had property inspection waivers. And if you think about your basic community, I mean, where you live right now in Gualala, one of the most beautiful places in the world, it's kind of one off in terms of doing valuations. So that might not fit ever for a property inspection waiver. But for a basic home, in the basic city, where there've been multiple sales of similar properties, maybe property inspections will just increase over time. So I don't know what it's going to take. I'm
I
not good
thought
at,
of something as you were saying that, and it's almost like what we thought the NAR settlement would become. I think we could see for loan officers, where somebody applies for a loan, and it's basically, hey, pick your level of service that you want. Call it 1 to 10, from no hand holding to extreme high touch, and you're going to pay comp based on that. And I'm sure maybe right now there's legal issues or there's compliance issues associated with that, but I would think that that's the way that it would be. Consumers could agree to, hey, I don't know what I'm doing. I've never bought a home before. I need help with this. I'm willing to pay a little more so that I feel like I know what's going on versus I've done this is my fourth house that I bought. I can sail through this. I don't need to pay somebody a bunch of comp. And there could also be overlays with how intricate the files are, for there could be additional fees. But I would think that it would become maybe more like an a la carte type of thing. For conventional conforming loans, there's much less of a fee than for a non-QM or jumbo
Mhm.
loan type of thing. I think that could be good. And I referenced your newsletter. You mentioned 1966, you were looking at getting a credit card, and all that, used to be that somebody, you had to go sit down with a branch manager, and then they'd ask questions and that sort of thing. Now it's all automated. I would think that the home buying process is still daunting enough that it will never be fully people aren't comfortable doing it without a realtor, aren't comfortable doing it without a loan originator. Is that the sense that you get working at a bank and seeing various clientele there?
No, I think there's a category of situations where people will be comfortable. So let's just say somebody's doing a rate and term refi and they've been in the house for 10 years and rates have dropped a lot. All they want is a lower rate. It's nothing unusual about it. I don't know why they need somebody to hand hold them through the process. At my last bank, and this was more commercial loans, but we did a number of refinances where we already had the file. The customer had his banking account with us. We knew the customer. We had the credit score, and we would just drop a new note. We would literally tell them, if you want to do this, we'll drop a new note, and you can come in and sign it. We'll mail it to you, whatever. So things can be simple, and I think in any given market, in 2020, when you had a refinance market that was huge, there must have been a very significant amount of loans where most borrowers just didn't need somebody to hold their hand, where literally they could maybe even at some point down the road go to a website, click on something with their lender and say, I'd like to lower my rate, I want to refinance it, and which option I want. And then, either I'll go to a title company or an escrow company to sign the next day, or maybe it's just done online somehow. But don't you think that, Robbie, for a large number of people, at least doing refinances, it should be just like clicking something on your computer and you get the new rate?
I agree that a refinance should be
Yeah,
treated a lot differently, and we might see that with Freedom owns almost $400 billion in servicing. Rocket's been making servicing plays. UWM making servicing plays. With the consolidation there, I think we could see some movement on the refinance side of things. I want to kind of put a bow on all of this, and I will say the word that I was looking for, the phrase I was looking for at the start was sacred cows. We had said elephant in the room, and then now it's sacred cows and
sure.
a bunch of animal analogies. But when it comes to companies looking to cut costs or be more efficient, you do you do consulting for a lot of companies out there. You have a good finger on the pulse too. And if we're going to treat LO comp currently as somewhat of a sacred cow, where yes, we will probably see movement in the future, but for now, call it a sacred cow. Where are you seeing companies get more efficient on their cost structures?
Well, first of all, everybody was very slow. The vast majority were very slow coming off of 2021. Until about a year ago, they were still very bloated. And I would say only in the last, 9 or 12 months, have we seen people really getting their cost to originate down to the point where they can make money. So we see very few companies losing money anymore. And when people come to us for a profitability review, it's not because they're tired of losing money, it's because they want to make more money. My first comment was that they were really slow to the party. There were too many sacred cows. We can't let so and so go. We can't let I have seen a couple clients, pretty sizable, take their servicing in-house. In 1995, there were a bunch of heads of mortgage companies, and they met at my bank because we had a big conference table. And they were talking about what became a price engine. There was no price engine. And we talked about we needed to come up with one. And eventually, I don't know who was first. I think a bunch of them happened at once. But I think that something like that's probably going to happen really soon. That people are going to get together. It has to be happening probably at ICE or Black Knight, where they're thinking all the friction points or as many as possible to allow loans to go through more smoothly, whereby the longer term impact may be doing away with the need to pay loan officer commissions. And I think, we both agree it's going to start off with refinances, probably start off with rate and term refinances. But at some point, my guess is, unless it's something really difficult, maybe like you said, non-QM or just something, maybe at some point, 10, 20 years down the road, it will happen where we don't need loan officers for even those kinds of loans. I don't know how credit cards are originated now. I think I have the same credit card I got in 1966. But I realize it's probably just a credit score and not much more than that. But I don't know what goes on, behind the curtain. But somewhere along the line, they made what was a very clunky process very easy
Yes, it takes about 30 seconds to apply now.
with mortgages, and the impact, is going to ultimately be around commissions. But there are too many people in technology, certainly in mortgage banking, who are really, really smart and who are thinking about things like this. And I just don't know when it's going to be. I think we know it's going to be. It's going to happen.
Yes, regular listeners of this podcast will have heard me say before, there's a bleeding edge that comes before a leading edge. And I think some bleeding might have to be done in terms of companies, mortgage companies experimenting with trial and error here. And some might get burned, with their sales staffs. You could argue, you can train a younger generation to handle the vast majority of the loans, and the more experienced people that demand higher comp, maybe they're suited for specific niche products, that sort of thing.
Or, Robbie, maybe it's not even, higher compensation in terms of commissions. Maybe the easy loans, there's a crew of people that handle those. What's interesting, back in 2022, 23, when things were really ugly, we saw companies all over the place, companies that were losing money, some that lost money to the point where they went out of business. And in the meantime, the mortgage originators were just making tons of money. They were making their 110, 115 basis points, whatever it might be. And it just seemed crazy. It seemed wrong that the company's going broke and these loan officers are making a fortune. And it's situations like that, I think, that lead to inventions, discoveries, new creations. So it's out there. It's a matter of time.
Yeah, and it has been nice through this market cycle to see companies expand products and programs to cater to more borrowers out there. Look at the rise of non-QM or DSCR lending. It's nice to see innovation, or what do they say, that necessity is the mother of all innovation. Nice to see through necessity the industry has evolved. You're touching on a different subject that I don't really want to get into in today's interview, and that is how much originators actually care about the companies they work for versus being willing to undercut a capital markets department, ask for price concessions. They, as long as it doesn't hit their pockets, I don't know how much they care about the company's pockets. I'm going to get in trouble for saying that. Maybe that's probably a good place to end the interview here as a ex capital markets person, putting my fist in my mouth.
Robbie, that's another discussion. You're right, but in a sense, the origination of third-party lending was a function of the fact that companies didn't want to pay loan officers so much. So, when third-party stuff, what we call wholesale, started around the mid 80s, and I remember watching it. Instead of paying loan officers, 125 basis points, you were paying AE reps, 10, 15, 20 basis points.
Yep.
So that there even sort of off, originations to a mortgage broker. Mortgage broker made a commission, but at least the company didn't. It was now just paying 15 basis points to an AE. So even that there was kind of a reaction to, even if not intended, to the fact that they were just paying too much for loan officers. Anyway, let's look at our calendars and set a date 10 years from now and then 20 years from now and see what happens. We'll compare notes, okay?
There you go. Yeah, you make a good point there. The TPO space has evolved. Look at the biggest lender in the nation now. Yeah, UWM, all through the wholesale channel.
That's right.
Brokers. So yeah, something to be said there. I always appreciate the time. Thank you very much, sir.
Robbie, by now.
Today's busy economic calendar contains some first-year data, starting with retail sales for June, which were up 0.6%, more than expected. We've also received June import prices, weekly jobless claims, which came in at 221,000 lower than expected, and Philadelphia Fed manufacturing for July. Both those reports I mentioned point to a pretty robust economy. The uncertainty introduced by President Trump's ever-evolving trade agenda has made it difficult for business leaders to commit to hiring or expansion plans until there's further clarity on the forward outlook. Later today brings the NAHB Housing Market Index, May business inventories, Treasury activity that will be headlined by $13 billion of reopened 20-year bonds and $21 billion of new 10-year tips, Freddie Mac's primary mortgage market survey, and remarks from multiple Fed speakers. We begin the day with agency MBS prices slightly worse than Wednesday's close, the 2-year yielding 3.93, and the 10-year yielding 4.48 after closing yesterday at 4.46%. Let's wrap up with a joke and some housekeeping. We couldn't lower your interest rate, so we gave you a bigger welcome packet. We couldn't improve your credit score, so we added more exclamation marks to your loan approval letter. Underwriting couldn't verify your income, so we added more disclaimers to the approval letter. The home didn't appraise for value, but we framed the appraisal in a really nice folder. And the property came in low, so we made the photos high-res to cheer you up. Thanks again to Ocrolus for sponsoring today's podcast. Ocrolus is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights that empower underwriters to make timely, confident lending decisions. To learn more, visit ocrolus.com.